Hello everyone, my name is Srishti Sahuji and welcome to our channel. Today we are going to dive into a very important topic from rural and microfinance, the MFI Group Lending Model. In next 7 to 8 minutes, I'll cover what is group lending, why do MFIs use it, how does it work step by step, its advantages, its limitations and some recent trends. Let's get started. Today's topic is meaning of MFI lending model under the subject rural and microfinance as taught by Professor Sudhanshu sir at PIBM College. So, what exactly is the MFI group lending model? As your class notes clearly define it, the group lending model is a microfinance delivery mechanism where MFIs lend to individual organized into a small groups with joint responsibility for repayment. Now, let's break that down simply. MFI stands for Microfinance Institution. These are organizations that give small loans to poor and low income people who cannot access traditional banks. In the group lending model, individual does not get loans alone. They form a small groups. If one person defaults, the entire group is responsible. This brings us the most powerful concept in the model. Social collateral replaces the physical collateral. You don't need land. You don't need gold. You need people who trust you. Now, why do MFIs use this model? Think about the people MFIs serve. They have no collateral, no property, no asset. They earn informal income, daily wages, hawking, small trades. They live in remote areas far from bank branches. They are costly to monitor individuals. For banks or MFIs, giving individual loans to thousands of such people is risky and expensive too. Group lending solves this beautifully. It reduces default risk because peer pressure ensures repayment. It cuts transaction cost. You deal with one group, not 10 individuals. It increases the outreach. You serve many unbanked people at a scale. It builds financial discipline. Regular meetings create habitats. Let's now look at the structure and how it actually operates. First, the group composition. A typical group of 4 to 10 members, they are formed from the same locality, have a similar socio-economic background and most importantly they are self-selected each other. No one is forced into a group, right? So in step 1, the group formation, members only come together voluntarily from the same area, similar income level. Second step is MFI training. Before any loan, the MFI trains the group. Rules, repayments, discipline, how to use the loan productively. In step 3, loan disbursement, loans are given either all at once or one by one. The loan goes individually, but the liability is collective. This needs to be kept in mind. Step 4 involves the weekly meetings, group meetings weekly or fortnightly. This is where peer supervision happens. Members monitor each other. And in the step 5, we can see that the repayment step, installments are collected weekly in cash or digitally. If someone can't pay, the group steps in. Immediate action on the default is taken. Your notes are in such a way that the 6 key features of the group lending model, I'll walk you through them. The first is the joint liability. The group is collectively responsible for one member's default. This is the heart of the model. No collateral. Trust and peer pressure replace the need for any physical asset. The third is the regular meeting. Weekly or fortnightly keeps discipline alive. Standard loan size, loans are small and uniform. No one gets dramatically bigger loan than other. Keep this group fair. Progressive lending, as the repayment improves, your loan size increases. This is a big incentive to repay on time. And the last, sixth is high frequency repayment. Weekly repayment matches the cash flow to informal workers, right? So the small amounts frequently and easier to manage. Now, this is the intelligent part of the model, the economic logic. Why does group lending work so well economically? Peer screening, peer monitoring, peer pressure, dynamic incentives, or economically. Let's see. So, in peer screening, when group members choose each other, they naturally select reliable people. They know who repays debt and who doesn't, far better than MFI officer can, right? So, the peer monitoring is done after the loan is disbursed. Members watch how each person uses the money. Social eyes replace the expensive MFI monitoring. The peer pressure, nobody wants to default in front of their neighbors, friends, or communities. The social cost of defaulting is very high. Dynamic incentive means the future loans depends on the current repayment. If you pay today, your next loan will be larger. This keeps everyone motivated. Economically, we say that these four elements reduce two classic problems: adverse selection, screening borrowers, and moral hazard, ensuring borrowers use loans properly. Every model has two sides. Let's dive into the advantage first. For MFIs, low default rates, repayment is strong, reduce monitoring costs, peers do it, rapid scaling serve many people quickly. For borrowers, easy credit access, no asset needed, no collateral, social trust is enough, build financial discipline through regular meetings. And now, the limitations of the MFI. Peer pressure causes social stress. Yeah, group break up risk, over indebtedness across MFIs, and also the limited loan size for the growth, which turns out to the sour relationship. Over indebtedness means the borrower sometimes take from the multiple MFIs, limited loan size not suitable for growing our business that needs the larger credit. Social conflict means the group dynamics can get complicated. Your notes also include the quick comparison of the group lending versus individual lending. So in this slide, you can see the different criterias relating to group lending and individual lending, such as collateral, risk, monitoring, loan size, and stress level. In group lending, you don't require collateral and the risk is shared in the group, but it's not same for the individual lending. In individual lending, collateral is mandatory thing and risk is beared by the own single person. Loan size is small in group lending, and in individual, as the risk is beared by a single person, also the collateral is there, so it is having a loan size of high. Now, let us see the recent trends in the group lending. Before we wrap up, a quick look at the recent trends shaping the future of group lending. Hybrid model MFIs now combine group lending in the individual credit based on the credit history. To prevent the multiple borrowing across different MFIs, insurance bundling, life health insurance is now attached to group loans. Digital repayments, mobile repayments, and digital tracking are replacing cash collections. This model is evolving, but the core philosophy of social collateral remains unchanged. And for the last slide, the key takeaways are the group lending, social collateral, peer screening monitoring, and the pressure reduced through default risk. High repayment rates are not equal to absence of social stress, and progressive lending, incentives, timely repayment, regulations also ensure sustainability and borrowers protection. In the end, this is the complete breakdown of MFI lending models straight from the class notes to all the subscribers over here. If this video helped you, please give it a thumbs up, share it with your batchmates and subscribe to the Learning Hub. For more such exam videos, drop your questions in the comments and we will surely solve your doubts. Thank you.